Hi, I wanted to give an explanation of essential question number 1 that was given on April 16th during the spring of 2012. The way this one works is that you are the owner of a small computer software company. And the first question, which we will go ahead and do in orange, is about hiring 50 new programmers to work for you. Now remember, people aren't assets, people are expenses to you at this point. So what you're doing is you're increasing your operating expenses by whatever the cost of 50 new programmers is. This is something which is going to go ahead and decrease your net income. Now remember, the sign convention on these two things is expenses, when they go up, you have larger positive numbers. Your net income goes down, and that's going to mean a decrease in cash from operations. There is this connection that you always have to remember. Anything that changes net income will go over here and start changing cash from operations for you. And that should kind of finish off question number 1. Of course, there's going to be the resulting change in net cash flow, but we'll kind of ignore that for right now since it's not essential for you getting full credit. Next question, take out a loan, interest-free, in order to have extra cash on hand. I feel like we keep asking this question, but that cash that you get ends up being an increase in assets. It's the cash. You also have a resulting increase in liabilities. Now remember, anytime that you have assets and liabilities changing around, make sure you get it so that the change in liabilities plus the change in owner equity equals to the change in assets. If you're lucky, you can have everything have in the assets, but this isn't one of those cases. The other thing to spot is that anytime you have some kind of change in liabilities, it tends to flow through into finance. Same thing with owner equity, it tends to flow through into cash from finance. And asset changes, if you're buying and selling something other than cash, it tends to show up in investments. So following through here, this increase in liability taken a loan means that you've got an increase in cash from finance. Remember, cash flow is about following cash. It's not about following anything else. It is merely about the cash. And that should go ahead and finish off question 2 for us. Let's go ahead and check question 3. An order of office supplies arrives, and you pay for it with a credit card. Tricky things going on here. Now, the first thing that's going on is you've got these office supplies that are showing up. So you've got an increase in basically inventory. Well, we've got to go ahead and balance off this increase in assets. And what you've done is you basically encourage yourself a liability here. So you've got an increase in liabilities too. Now here's where things get complex. You notice it looked like no cash changed hands? Well, that's because there are actually 2 transactions going on. First, you were going ahead and buying yourself inventory, so you had a decrease in cash from investments. Second was that you're taking out a loan at exactly the same time, and those are balancing themselves out for right now. And that's why it looks like there's no net change in cash. It's because you had it flow out in one place and flow in from another place really fast in the same transaction. All right, moving on to the next question, which we'll do in green. Company decides to issue 1,000 shares of stock. By the way, you're selling it, you're going to get some cash for it. So you get some increase in assets right here. That's the cash you're getting for that stock that you're selling. And at the same time, you're going to see an increase in owner equity. Now you see we're following that principle. Increases in assets are balanced off by increases on either liabilities or owner equity. Please note, increase in cash, so there better be some kind of change on the cash flow statement over here. And changes in owner equity show up in finance. So you've got an increase in cash right there. Simple enough. Next one, which we'll go ahead and show in blue, is you purchase some advertising space on a popular image board site. So you're doing some expenses right now. So you've got an increase in expenses. And please note that we haven't gotten to extra sales coming in. We just incurred an expense. And this one should look exactly like question number 1. Exactly. So it's the same transaction effectively restated in a different way. So there's the blue one for you. Because all it is an increase in expenses, and that's it. Moving on to, sorry, I had a small box of crayons. I like blue, green, something along those lines. Make a payment on your loan, interest-free. And the interest-free is there to make it so it's easy for you. So what's going on is that your cash is going away. And at the same time, your liabilities are going down. So see that it balances out right there. Payments on loans tend to reduce cash from finance, and that's the connection that's there. And please note that we have this change in liabilities will tend to flow over into changes in cash from finance. That's the connection between those 2 items. And let's go ahead and switch over to the next one, which is purple. I know that color. Your company receives a $5,000 award for one of your products. I think the best way of thinking about this one is it's some revenue that comes flying in for you. Increases in revenue results in increases in net income, which results in increases in cash from operations. So again, basically, whatever you see at the bottom over here as changes in net income will exactly mirror itself over here in changes from operations. And then finally, in black, your feature is a TED speaker at a TED Talks conference, and the exposure brings you tons of new clients. Okay, so this is one where it could go a couple of different ways. One, we know we've got some revenue going up, but you probably have some expenses going up at the same time. And the net effect of this is a bunch of who knows. It could go either way, and you'll probably get credit for either one. Now, the same thing that you're going to have for the net cash flow. You don't really know which way that's going to go, but remember, basically, whatever happens down to net income, that gets mirrored up here in cash from operations. It's the connection between the two. And that should go ahead and finish off the answer to essential question number 1 that was given on April 16th in 2012. Thank you.